So what I'm going to talk to you today about is a study that I've done of the experience with catastrophes in the United States over the past 32 years. A very rich data set, and I know we've had some discussion or some presentations this morning that talked about the need for some data, some more analytical work. So today I'm going to show you kind of the possibilities of what you can do if you collect some data, some things that you can learn from the richness of the data that we have. So I think it's pretty clear where the academic interest in catastrophes lies, and this is not anything new to the audience, but the number of catastrophes and the size, the damages associated with catastrophes is increasing. So of course that leads to all kinds of research ideas for what we can do about this. And the goals of this research suggests in the insurance context that we need a distinct risk management approach to catastrophes than those that we have had for other types of losses in the insurance industry. And as we've also talked about this morning, we need to consider the interests of all the stakeholders, and not just the interests, but also the incentives of all the stakeholders in this issue and how they can be involved to help, especially with regard to preparedness as well as recovery. And again, these are not anything new, what we've already kind of set the backdrop of this morning. Today I want to consider the role of insurance regulatory environment. So the incentive of the regulation in terms of how they are going to give the insurance industry the appropriate tools, the flexibility that they need, but also monitor the solvency, monitor the behavior of those insurers in the market. So this is a balancing act. It's something that I've studied for many years in the United States, how the regulatory as well as the legal environment tends to disrupt or correct market imperfections. And anyway, I'm going to show you a little bit analysis of what I've learned by looking across 50 states in America to see what those regulatory and legal environments look like. The main concerns we have in the research would be whether the insurers are involved in helping to ensure the preparedness. So as I talk about regulation, one of the goals of the regulation should be to incentivize the insurers to subsequently incentivize the consumers to mitigate against losses, or to incentivize communities, or whichever the appropriate body would be, to help to be prepared for the losses should they occur. And then with respect to recovery, just highlight again the role of the regulator to ensure that payments are made on insurance policies, to make sure insurance companies are able to meet their promises that they've made to the policyholders. So it's a very complicated system, of course, when you look at the different stakeholders, and I'm singling out three primary groups here: the individuals who have the opportunities to mitigate against the losses, and we're interested from a research perspective in how those individuals think about losses, or think about the potential for damages. We know that there's still a long way to go with educating people about what their risk is. Some people that know still tend to overestimate what the probability will be, especially for small types of events, or underestimate large probability events. People are much more afraid of dying in an airplane crash, which is not very likely to occur. That body of research is very informative to how this whole system works. In addition, then, the private insurance market, we're interested in the strategies that insurers can undertake to ensure that they have the ability to write policies, the capacity, that they are also involved in strategies to diversify their risk, to make sure that they are able to meet those obligations on a regular basis over time. And the regulator I see as a necessary cog in all of this, because there are imperfections in both of these areas in particular. Consumers need additional information that the regulatory environment can help to encourage. Insurance companies need to be monitored in terms of their capitalization, how they are approaching consumers in the market, the information that they're providing. So specific forms of regulation that I've been mostly involved in studying, the insurers' rates in the states. Insurance companies are regulated at the state level. So if you operate in Alabama and you operate in Florida, if you operate in Michigan, in each of those states you have to file the rates that you want to charge for coverage. It leads to a fairly burdensome system of having to justify with actuarial reports what your losses are and explain why you need a 10% increase in a given year or 5% increase. So there are forms of rate regulation that vary from state to state. Some states are more restrictive. Some states require that you file a rate and then you wait maybe up to 90 days or more for the insurance commissioner to approve. In other states, we have a much more competitive environment where the insurance company can file a rate and they can start using it. And the regulator, the commissioner in that state, has some time to review and possibly deny and make the insurance company roll back the rate. There's various forms of that which I will look at in the research in just a moment. We also have forms of regulation that insurance regulator looks at the insurance company's forms to make sure that the language in the form is clear, that the coverage makes sense, that if there are any mandatory coverages, that those are clearly included in the policy forms themselves. And of course, we have the regulation of insurers' solvency. We have risk-based capital requirements. Those are monitored by the state in which an insurance company is domiciled. So if I organize my insurance company in Delaware, and the Delaware insurance regulator monitors the solvency, even though I may write in many other states and have to file my rates in other states where I do business. So maybe I've already lost you a little bit on how complicated the system can be in the United States for an insurer, but as a researcher, the benefit to me is that there are so many environments where things are changing that I have opportunities to see what's working better. Right? So if I want to try to find best practices, I may see that things are working better in one state than another, and I can look at whether that has something to do with the regulatory environment, the legal environment, the education of the population, other types of programs, et cetera. So I will not go into much about evaluation of other types of programs because I don't have a lot of good data on that, but I am going to look at rate regulation, and I'm going to look at the existence of a residual market. So another thing that some states, especially in cat-prone states, operate is a residual market for the high risks. In some places, those residual markets are set up to accept people on a temporary basis. So after a big storm like Katrina, individuals that could not purchase coverage from the private insurers because the private insurers were facing capacity problems, those individuals go into a state market, and the goal is to get those individuals back out at some point. So they go back to the private market when the private market recovers, and you hope that that doesn't take too long. They get access to capital, they find new sources of reinsurance, and that residual market can either go away or shrink. In Florida, we made a mistake of creating a residual market and allowing it to grow and grow and grow to where there are 60% of the policyholders in that state market, and not that many incentives for the private insurers to come in because that residual market is underpriced significantly. So the private insurers cannot compete with it, and therefore they're not very likely to come in. So there's been, over the last few years, some attempts to try to increase the rates in the residual market and allow the private insurers to come back in, but it's happening very slowly, and would argue that this is not, that's why I don't feel like a very good example of, Florida's not a great example of what you want to learn about in rate or residual market regulation. Okay, I'm going to look at the best practices, what I think of a movement toward understanding best practices for regulators with the goal of ensuring market stability. So I need to make it clear that what I focus on here is really on the supply side. And I understand that we've heard about a lot of demand side issues, getting people to buy the coverage that insurers are ready and willing to offer, but they may not have the demand out there. But what I want to talk to you about is in a market where there is demand and supply, maybe we're at an equilibrium, and then a catastrophe occurs. And what the regulator does not want to have happen is for those insurers to leave and create a disruption, so that there's now excess demand, and those individuals have to go and shop around and find coverage somewhere else. So I'm looking at the existence of a market that may actually be operating pretty well until a catastrophe hits. And then best practices might be the market that's set up appropriately so that when that catastrophe hits, there's as least disruption as possible. Okay, so that's what I'm trying to uncover here. I recognize it's a real political challenge to regulate the insurers in any state, and one reason why is that these states, besides having different forms of regulation than other states, they also have pretty well-developed markets, insurers that operate in niche markets across the state. And when there's a disaster somewhere in a state, it's not always felt by all insurers in the state. So we have a problem with regulators wanting to react with a knee-jerk reaction after an event has hit in a state because damages are so high, and yet when you look at the insurance market, you find that it's 2 or 3 insurers that had the largest aggregation of losses. And the insurance regulator needs to think about whether or not a response is necessary to save 1 insurer or 2 insurers, or whether the response that's necessary is one that preserves capacity in the market. So the data here just highlights the fact that sometimes the average loss ratio or the median for the state may still be pretty reasonable after a year of a catastrophe in the state, even though some insurers are hit pretty hard. And those insurers may have to be covered by some type of guarantee fund. The state may need to step in and help them out. But when the state as a whole still has capacity and insurers that are able to function, there may not be a need for some type of reaction. And the type of reaction I'm thinking about there, the knee-jerk reaction would be requiring every insurance company to stay in the market, or to require them to give some type of rate reduction or pay claims that they may not have wanted to claim that the policies would have excluded before. So in some cases that's occurred. So my point with that last slide is also that not every catastrophe creates a state-level crisis, right? So there could be a catastrophe, again, that affects a few insurers. We have a system in place to recover, and the regulator may not need to react. But what I consider a catastrophe in my analysis is an event that actually has a pretty big effect on the state. So when there is a pretty big effect, loss ratios for the insurers at 1.25 or more. That's maybe not, that's pretty low threshold, but under that type of definition, what I do over the last 32 years is I identify 51 states in a particular year where there was this type of event. Right? So that's obviously not every flood or hurricane or tornado that's occurred across the states, but I think of these as significant enough that there could have been disruption in the state insurance market. So those events over a 32-year period, and I'm trying to now identify if, when those occur, are there certain characteristics of the regulatory environment that lead to less disruption. Okay? And the things I'm looking at are the existence of a residual market and whether or not the regulator regulates rates in a restrictive manner. Okay? So if insurance companies cannot automatically increase their rates and have quite a burden in order to increase their rates, want to see what kind of effect that has. I'm going to focus on those 2 regulatory practices, and then I'm going to look at 5 measures that I think of as being measures of how the market is doing. Right? So before a catastrophe occurs, you have a number of insurers that operate in the market. They have an amount of capital. They are competitive or not in the market, depending on how many you have and the market shares of those insurers. There's an amount of reinsurance that can be supporting those insurers in the market, and performance, okay, the loss ratio of the insurers operating in the market. Together, I think those 5 measures say something about, if you look over time, about how a market is performing on different dimensions, and I have to say they're not they can't necessarily be considered completely individual. You have to think about all of these in concert. So I'll make some points about that as I look at as I show you the results of the analysis. I have, as I mentioned, data that goes back to 1984. I'm going to focus on the results for the homeowners insurers because I think we're mostly interested in that from a policy perspective, but we do put into the analysis the commercial insurers and find in general commercial insurers perform much better than the property casualty insurers, possibly because they are given more flexibility. I look at the key measures over a 2-year period. So I look at changes in capital, changes in the number of insurers, changes in the amount of reinsurance over a 2-year window to see how things are affected post-catastrophe. And then I look at 3 primary effects. I mentioned the rate regulation, the residual market, and then the existence of a catastrophe. There's also some controls in there. We have, over this period, movements in terms of housing starts, more population moving to some states, so I have to control for that, to control for the size of losses. So I look at 3 things that affect the market, those market measures, the 5 market measures I mentioned, and I'm especially interested in the effects of these things as they're interrelated. So if there's a catastrophic event in general, does that have an effect on a market? But more importantly, I'm interested in if there's a catastrophic event in a market where there's rate regulation, do we have a differential effect? So in this case, rate regulation, and in my analysis, is a 0-1 variable. Either a state has kind of relaxed rate regulation or they're restrictive. So if you're in a restrictive environment and there's a catastrophe, do we see a stronger effect of that catastrophe than in a less restrictive environment? And the same thing with the residual market. If there's a residual market operating in the state, it's really proxying a lot of things. Just in Florida, it probably proxies the regulatory environment and the political environment. But if you have a catastrophic event that occurs in a state that has a large residual market, what does that do to the private market? Okay? So I'm interested in those last 2 pieces especially. So market size, the number of insurers operating in the state. One expectation would be that the number of insurers would leave after state if they're affected significantly in their capacity. However, that some insurers may enter a market given that there may be opportunities now to come in to a state where there was too much competition before. It's an empirical question and mostly depends on whether insurance companies see the catastrophic event as some kind of indicator of what the future is going to be in that market. So if this event is big enough and has as a surprise, then it may be more likely insurance companies are going to react. In other research I've done, we look at how insurance companies respond more to surprise events than they do to just one more year of something. So especially like tornadoes that occur all the time, you don't expect an insurance company in 1 year of tornadoes to just exit the market if they've been experiencing them over time and have the opportunity to adjust their rate structure. Okay, so the analysis of market size, what I find is that catastrophic events by themselves do not seem to affect the size of the market in a state. The number of insurers that exit or enter seems to balance out over this period of time. However, if we look at strict rate regulation on its own, not with regard to catastrophes, but the existence of strict regulation, that's actually associated with a negative or a reduction in the number of insurers in a state. So as we see in the United States, the number of insurers that operate seems to keep going down in places where the insurers are not given the flexibility to adjust their rates. Similarly, the size of the residual market is associated with a reduction, and I gave you the example of Florida that's consistent with that result. Now, related to insurers exiting or entering a market, we have the potential for competition to be affected. We find, in this case, using the Herfindahl Index of Competition, that the number of insurers had not changed, so competition also does not really change. But the result would really depend on whether big insurers were leaving, small insurers are entering. So in Florida, in fact, that's what we see. The big insurance companies have left. Small insurers with very little capital have entered the market. In general, we find that the restrictive rate regime is leading to insurers exiting, so that's creating less competition or higher concentration in the market. And the size of that residual market is positively related to the homeowners market, and especially when we compare it to the commercial market. But we do find that after a catastrophe, we do see a bit of a significant effect on market concentration. Now, surplus, we would want there not to be a large change in the amount of surplus that's supporting the risks in a state following a catastrophe. We do expect some reduction immediately following the catastrophe, but within a couple of years, we'd like to see that capital comes back to the market. So we think that in the short term we might see an effect, but over time I'm interested in whether or not these regulatory regimes are responsible for how quickly capital comes back into the market. So we find that, again, catastrophic events by themselves do not seem to affect the amount of capital that's available in a state within a couple of years of the catastrophe. However, with states that have this restrictive rate regime, companies that have capital are leaving. So this is consistent with the other two findings. The big insurance companies are the ones that are leaving the markets after a catastrophe and taking their capital with them. The states that have a large residual market also see a reduction in capital. We saw that that was associated with exits from a market as well. So in this now, I've kind of shown you three market measures. The theme that I'm getting at here is really not that the catastrophes seem to be having an effect, but some of these other regulatory environments are moving us in a direction where we have fewer insurers, less competition, less capital. At some point, we're going to have maybe degradation of the market so that the catastrophe in these states is going to have a much more significant effect. With reinsurance, we look at a ratio of the reinsurance ceded divided by reinsurance assumed and direct premiums written. Again, not sure what the effect of a catastrophe would be, because insurance companies might purchase more reinsurance after an event, but they also may have a hard time finding available reinsurance, or the price will have changed after some events. It may be difficult. What we find is that the states that have restrictive rate regimes, those insurers buy more reinsurance. So that may be, in a sense, because it's covering the fact that they are not able to get the rates that they want in a restrictive rate regime. They're being suppressed to some extent. The higher residual market, the bigger the residual market in a state, seems to also be associated with a lower reinsurance ratio by the private insurers in the market. And the reinsurance ratio, again, unrelated to a catastrophe by itself, but related instead to the regulatory regime. And then finally, with underwriting performance, we expect that if insurance companies anticipate that the event, a catastrophic event, is an indicator of future losses, that they would try to raise their rates, and we would see a loss ratio improving. So it would go down within a couple of years after an event, or at least not increase. We find there's no kind of contradictory to a lot of the research. We find that the performance of the property insurers and the regulatory environment with respect to rating is not significantly, they're not significantly related, but the residual market share is related to how the private homeowners market it operates. So residual markets, like in Florida, have led to a less profitable private market. And that effect is even more significant if you look at the size of the residual market in a year following a catastrophe and what that means for the private insurers. So large residual market, catastrophic event, the private insurers perform even worse than in other years. So as I said, all these results need to be taken in context, and I tried to relate some of these different results to each other. It's important to think about the number of insurers, the competition, profitability as all being interrelated, and also to understand that I'm looking at a very limited set of things that could be happening. Now, in my analysis, I'm controlling for all kinds of things that could be omitted from this analysis, in statistical sense, by including some variables for each state. But some of these things that could potentially be important would be when a state requires that the insurer stay. They can't leave the market. So we call it a cancellation ban. Something like that could be important. Also, although we find that the main conclusions that both rate regulation and residual markets seem to be associated with worse outcomes in terms of the stability of the insurance market. We recognize that both of those are are proxies for a more general number of things going on. And one thing I'm learning as I speak to all of you and travel around is all of the individual events that happen in individual countries. And I can do the same thing by going from state to state in America and talk to the regulators and talk to the stakeholders in each state, and you hear about a little characteristic that can't be captured really well in the academic way here in as a coded measure. So we're trying to get a little bit more granular in this type of analysis to drill down a little bit more into what we mean here. So for instance, with rate regulation, what we find is that I've said something's either restrictive or not, right? And obviously that's not clear. There's a spectrum if you look across the states of which states might be more restrictive, some that are kind of not. And what we're learning is that that's not even a one-dimensional thing, because there could be the insurance regulator takes a long time, so it's just a timeliness issue, but the insurers get the rates they want. They just have to wait. Then there could just be the insurance regulator saying you don't get to raise your rates. And they might make that decision immediately, but in that case, I might call both of those environments restrictive, and yet they mean very different things for the insurance companies that are operating in those states. So we've been trying to gather data by talking to the carriers across the country and asking them, what is your experience when you operate in Alaska? What's your experience when you're in Georgia? And get some characterization of that to help to clarify this. So I'll just wrap up with my thought here is, and I'm showing you some academic research that I can do because I have a very rich data set in the United States. Of course, I show you there's still some limitations to that, but I do have a lot of information at the carrier level to know what it is they're doing. Maybe the harder thing is to characterize the environments that they operate in, because there's the political, regulatory, legal issues, as well as the public perception of what's going on, education levels, financial awareness. But I want to encourage all of you to think about how you can help to develop some comparisons across borders to help inform the way that regulation develops in Romania and other neighboring countries, because I think there's opportunities if you can collect the information, start characterizing what it is you're all trying to do, that best practices can emerge from these types of studies. And just mention that there are a lot of studies in other countries that can help to inform this. I found several studies that actually look at the role of regulating insurers, restricting what they do in some way, and also some studies that have looked in other countries about the existence of a high-risk pool and what a high-risk pool does for the private market. So these studies are typically done in one country, and so you get an idea of how something happened in that one country. But if we can pool resources together and try to figure out, well, if this happened in one country and this happened somewhere else, what can we figure out might have been the better approach, right? So that's what I had for you today. Happy to take questions.